Hello and welcome to the Hoover Institution's 2013 Fall Retreat. I'm Chris Dower, Hoover's Director of Marketing and Strategic Communications. Our speaker in this podcast is John Taylor, the George P. Schultz Senior Fellow in Economics at the Hoover Institution, where he chairs the Working Group on Economic Policy. The title of his talk is, After 100 Years, What's Next for the Fed? It was recorded on Monday, October 28th, 2013.
Thanks, John. Thank you very much, John. It's so great to see such a great crowd here. I'm used to teaching freshmen in the morning, but today I decided to give them a midterm, and so I think maybe I'll give you a midterm after my talk, so make it all equal. John gave you the title of my talk. It has to do with the first 100 years of the Fed. It was actually voted into legislation in 1913. Took about a year to implement, so into 1914 before it was finished. A little quicker than Obamacare. The interesting thing when you think about the future of the Fed is what have we learned from those 100 years? And I want to kind of just give you an overview. It's obviously a lot of time and a lot of things have happened, from the Great Depression to Great Moderation, economists call it, but I want to sort of give some broad themes or pictures that I think are important for thinking about not only where the Fed should go, but where it will go, because there's two different things. So first of all, what have we learned from this history? What do we see? I think there's sort of three important variations or trends, historical movements that you can see over this period of time. One, of course, is that we've had huge differences in economic performance. Great Depression was terrible, a much better period, and historically speaking, with the 80s and 90s. We're now in a bad period again. The 70s were terrible, high unemployment, high inflation. So we've seen major changes in overall economic performance, which in some sense the Fed is responsible for, or certainly a big player in. The second thing we've seen are big swings in what I'll call de facto independence of the Federal Reserve. That's actually how independent it is actually from the government, from the executive branch. And that has varied tremendously too. Interestingly, it has not changed much in a legal sense. There's been a few changes in the law. When the Fed was first established, the Secretary of the Treasury was an ex officio member of the Monetary Policy Committee. That was changed in the 30s. But for the most part, it's been pretty stable in terms of the law. But we've seen big changes with de facto independence, how involved the Fed is with the government. During World War II, it really had no independence. It was responsible for pegging bond prices. It regained its independence in the 50s and early 60s. I would say it lost its independence later. I want to go over that really, really briefly. And then the third trend, up and down, if you like, variation, is how much attention the Fed paid to rules, if you like, or more predictable, more strategic types of policy making, as distinct from more discretionary, or kind of whatever it takes, wake up in the morning and decide what to do, more tactical, if you like. And there has been a big switch back and forth between those two, and I'm just going to sort of just go review them. So let me talk about the economic performance briefly, just sort of convey some facts associated with this. What I'm going to stress as I go through this is these three trends, these three movements are quite closely related, and I think that helps you decide where the Fed should be going in the future. So first of all, with the economic performance, I call this the EKG for the American economy. I'm going to look at really the last 50 years more than going back to the Great Depression. This is just the growth rate of real GDP in the American economy going back to the 40s. It goes up and down as the economy goes through periods greater and less instability. And you can see those growth rates were quite volatile in the 50s and 60s, and especially in the 70s and early 80s. Then things got quite smooth. Economists call that the Great Moderation. When that blue line goes below zero, and the zero line is marked there in the diagram, that's a recession. If it's there for a while, below zero for a while, it's a great recession like we've had recently. But you can see the amazing difference in performance. That's my theme here. In this period of really the 80s and 90s until recently, we had relative stability. It was kind of a long boom in the economy. It was doing very well. And then more recently, we've gotten into this really deep recession and what economists call the not-so-great recovery. And that compares to a remarkable recovery in the early 80s, which is that beginning of this so-called great moderation. So that's the differences in performance. Another measure of differences in performance is the unemployment rate. This is a picture of the unemployment rate going back to the same period of time. It has its ups and downs in the business cycle. But if you look carefully, there's some big movements here, too. Things got really pretty bad from the late 60s into the 70s, into the early 80s. Then things generally got better, and then they've gotten worse again. And that unemployment rate now really understates our problems because people have dropped out of the labor force. So if you look over to the far right of that diagram, you see there is a decline in unemployment rate. But if you correct for the fact that many people have just dropped out of the labor force and stopped working, the unemployment rate has not declined nearly as much. It's still quite high by that measure, probably around 8%. And so those are things to look at. The last thing to look at is what I call just measures of volatility in the economy as a whole. And economists use this a lot. The Fed uses it a lot. People who comment on monetary policy use it a lot. It just measures the size of the ups and downs in real GDP, that's the business cycle up and down, but also inflation, because obviously the Federal Reserve is most responsible for the inflation rate. So this table shows you that from the mid-60s into the early 80s, the bad period, we had very volatile real GDP. It was 3.6. This is a standard deviation, 3.6%. Inflation was quite volatile. It went up and down during that period. And then things got much better from 84 to relatively recently. A much smoother behavior. That measure of instability came way down, as did with inflation and GDP. And then recently we see things have gotten bad with respect to the overall economy, unemployment and growth and the sluggishness, but they haven't gotten so bad with inflation. Inflation has remained relatively stable. So most of the deterioration recently in the overall economy is this deep recession and slow recovery following that deep recession. Okay, so that's really my evidence that there are these major changes and shifts in economic performance. There are also these changes in de facto independence, the degree to which the Fed is independent of mostly the executive branch. Starting in the late 60s, the Fed became more dependent, if you like, more involved with the executive branch. There was the new economics coming to Washington, the Keynesianism, Kennedy-Johnson administration, especially in the Johnson administration, and basically they were able, I think, to have the Fed cooperate more in these kinds of policies. And William McChesney Martin was the chair of the Fed, moved in that less independent direction. De facto independence declined. With Burns appointed by Nixon, very clearly lack of independence, really gunned the money supply. There was this go-stop policy. We step on the accelerator and the brakes, and I think the reason for that poor performance you saw a few minutes ago in the slide. G. William Miller appointed by Carter, the same kind of thing. It wasn't really until a change in personnel occurred with Volcker that they really undid this. They went back to, I'd say, a restoration of the independence, de facto independence of the Fed, because the law's not changing here. It's the same law. So de jure independence is the same. But starting with Volcker, and I think for much of Greenspan's term, there was a real effort to separate from the particular demands you might get, say, for low interest rates or for intervening in this market, and it diminished substantially. I remember, this is a quote from Volcker as early as 1983, just reflecting on the fact that they'd reversed this. We have gone a long way towards changing the trends of the past decade or more, so they really got back to the sense of being responsible for their mandates and not succumbing to the wishes of the executive branch in particular. And then finally, I'd say we're unfortunately back to this question where independence is there. The Fed is involved in fiscal policy by buying a lot of the debt. It's been involved in credit policy by buying mortgage-backed securities, and similarly with the housing policy. It is really, if you like, much more intertwined. Its policy is much more intertwined than it was in earlier decades. And that's a reflection of the, I say, loss of de facto independence. Now, note here, when we say loss of independence, we frequently are imagining that somehow the independence has been grabbed by the executive branch. You must do this. We'd like you to do that. Like, say, in World War II, the Fed had to succumb to the goals of the country with respect to the war. It often goes the other way. It's actually the Fed or other central banks, too, that kind of look for other things to do. Sometimes they'll say, well, the government is not doing this. We got to come in and do it. We don't want to do it, but they'll come in and do it. So frequently this switch in independence comes from the central bank, not just the executive branch. Okay, so finally, also changes in this rules discretion balance that I'm talking about. And there's various ways to see this. In the late 60s and 70s, policy got very discretionary. This was completely against the recommendations of Milton Friedman, who was arguing against this. It was really the heydays of Keynesian discretion, moving away from, if you like, from rules and less predictability, less knowing what the Fed is going to do next. Really a guessing game, not very much transparency. Very clear as you look. You also can use these measures of rules, so-called Taylor rule that John was mentioning. You could see they're kind of way off that kind of a regular, predictable pattern. In the 80s and 90s, it really moved away from that discretion to a more steadier policy, steady as you go is the best way to think about it. If you want to look at specific studies or rules, you'll see they're much closer to those kinds of policies. The objective then was to get the inflation rate down of Volcker and Greenspan basically wanted to keep it down, so they didn't do a lot of other things. The main way to get unemployment down was to reduce inflation, is what they said at the time. So they kept away from these highly discretionary types of actions. And then recently, I think there's this veering away from these into much more difficult to understand policies, unprecedented policies, things that it's nearly impossible to do a rule about. There's an article in today's Wall Street Journal news section about how the Fed's trying to put in more rules into place with respect to certain things, and I'm quoted as saying, yeah, that's a good idea, but it's very difficult now because these policies by themselves are very hard to gauge their impact. But I have a few pictures, I think, that illustrates the nature of how discretionary and unpredictable policy has become. This is a measure, if you like, of the Fed's interventions into the economy. It's basically the amount of deposits that banks hold at the Fed, so it's a measure of liquidity. When the Fed has a responsibility, as part of the law, is to provide lender of last resort when the financial system freezes up. This picture has something that's hard to see over in the lower left here. That's first of all, the scale here is billion, so that's 5,000 billion, 4,000 billion. And there's a little blip right here, that's 60 billion. That's what the Fed intervened in 9/11, 2001. I was in the government at that point. We considered it a massive intervention. You can hardly see it in this picture anymore. But it also came out very quickly. That's one of the reasons it's hard to see. It was a beautiful operation. Liquidity was provided, and it was pulled out. I call that really good monetary policy. Very rules-oriented, just following what they should be doing. The next one is the 2008 panic, and I think in many respects, if this had been the complete story, it would have been just ideal. You had the liquidity operation come in with the panic. The Fed gave loans to banks, and many of those facilities were drew down after the crisis. This also would have been good policy, in my view. However, it didn't end. Instead, this happened. These are the purchases, represent the purchases for quantitative easing 1, that's the treasuries and mortgage-backed securities, quantitative easing 2, an extension of that, and then quantitative easing 3, announced just last year, just about a year ago, actually, in September and December of last year. And it's really, the blue is where we've been so far, and the red is a projection if it continues. So it is completely unprecedented. We've never seen anything like it. And therefore, it's very hard to know what to do and what to do with it. And you've seen that in the last 4 or 5 months. There was the hint by the chairman of the Fed, Ben Bernanke, that they may slow down these purchases, slow down that red exploding line. And the markets reacted very negatively. So, oh my God, what are they doing? They just announced it last fall. Now in May, they're withdrawing it. It's how predictable is that? That's called a tapering. And at that point, they really announced there would be this new quantitative easing, which is effectively just winding it down, winding down the size, not undoing it yet. Eventually, it's got to undo all this. They just sort of stopped the size, and that was called tapering. And then the markets got excited, the Fed got excited, and I'd say they basically chickened out, and so now they're back to the new quantitative easing, which we don't know when it will end. So this is just an indication of the sense in which the policy we're in now is very unlike, in many dimensions, but this is just one, very unlike the kind of steady-as-you-go, predictable kind of policies that we saw when things worked well. So there are statistical tests, other than just using a diagram like I've had, that economists have recently employed. I'm very much involved in these tests. It's kind of our research project. We're trying to test to what extent the policy is rules-based, is systematic, is predictable. And there are methods to do this. And it's good because it becomes more objective. You just can't make, that's a political call. You don't like what they're doing, you say it's discretionary. Or you like what they're doing, and you say it's rules-based. So it's meant to be a little more objective. So statistical tests. And when you do these statistical tests, it turns out it's very close to what I indicated. There's discretionary periods in the 70s, and it ended in the early 80s. It continued until recently, and now we're back in this discretionary period. And what's probably most helpful and promising about this is once you have these more objective ways to determine when these more predictable rules are in operation and when they're not, you can then go back and see what the performance was like. And by and large, the data say that the performance is worse in these unpredictable periods like we're in now than in the more predictable periods. So in my view, there's quite a bit of a causation, there's certainly a bit of correlation between these trends. And as I see it, there's a lot of causation. The switches from rules to discretion, and that's an old term, goes back even to Milton Friedman's teachers, rules versus discretion. It's a classic dichotomy in monetary economics. We now have evidence over the last 50 years, over the last 100 years. Milton wrote about this 30 years ago. When the Fed is more predictable and steadier, it's a limited purpose institution, if you like, focusing on inflation. It doesn't get into all these other things, doesn't try to do too much. Things work better. When they start to do these other things, it gets erratic. And unfortunately, there's unintended consequences, and I think that's what we've seen. So to me, the implications for the future, what's next for the Fed, is really how do we get to one of these more rules-based, predictable kinds of policies as we've seen in the not-so-distant past, and it worked well. The real question, and I'll sort of go through if you like, the chances of this, is what's actually going to happen. I think it's pretty clear to me, and I think a lot of other people, that's where we should be going. But what's actually going to happen? What are the chances? Let me just start with the discouraging signs. Some people are calling for QE forever. We should always have policies like this. It's not that hard to believe we could go in that direction. I think it would be very damaging. But if you sort of say, suppose things pick up really well, and they could say, it's because of the quantitative easing. I don't think you can say that, but people could say that. And of course, quantitative easing, there's many more things for the Fed to do. There's a whole lot of things. It could be frequently in the financial interest. A lot of people think the stock market is completely dependent on quantitative easing. There's a lot of inside information that people can trade on because of these kinds of policies. So you could imagine this could be where we go in the future, and that worries me seriously. I can't believe, I started being concerned about this back in 2009, and it's just continued, and you saw that chart. That chart just kind of going off the scale. So it's possible this will be the future of the Fed. I hope not. The fact that the Fed got cold feet at just mentioning the fact that it would reduce the size of the purchases, not sell, but just reduce the size, that was tapering, it concerned them. They undid it. They just basically, I would say, got cold feet. They were on the way to doing it, but they're not doing it. That's also a discouraged sign, because it could very well be that people realize these aren't working, but getting out of it is hard. That's actually what happened in the 70s. People realized that these inflationary go-stop policies weren't working, But it took another 5 years before we got out of it. Volcker came in and did the job. So I think we may be in one of those situations now. We know it's not working, or we're suspicious it's not working, but we can't get out of it. And then, perhaps most worrisome, some people are going back to the fact we just should reflate. This is it turns out front page. I usually read papers online these days, so I don't know what's front page and not, but it's a front page story in the New York Times that some are calling for going back to 6% inflation. I think that's really a sign of a highly unstable kind of policy. So there's the discouraging signs, and I think we have to, my perspective, need to make the case that that's the wrong way to go. What are the encouraging signs? Well, one is that many people are concerned about this now. So in the Wall Street Journal this morning, my colleague Ron McKinnon wrote a piece about how this is a problem. Volcker is writing about how it's a problem. The Nobel Prize winners, Edmund Phelps, are writing how it's a problem. Martin Feldstein writing it's a problem. I've been writing it's a problem. So more and more people outside the Fed, but also inside the Fed. There's a lot of dissension about whether this policy is correct. That's an encouraging sign, it seems to me. Janet Yellen is going to be the new chair of the Fed, most likely. This is, I think, in some sense, with respect to this rules versus discretion, could be encouraging. Janet Yellen has always been positive about the notion you should try to have a systematic policy. You should try to have a predictable policy. I've talked to her about this for decades. And so, in some sense, she's sympathetic to this. Right now, she says, sorry, these are not normal times, John. We can't do these kinds of things. We've got to do this stuff, this damaging stuff. But and that's where she is at this point. But at least there's a chance with the change in leadership there might be reflections here if it's coupled with the demonstration that the policies are not working. So I consider that an encouraging sign. May surprise some of you. Many people characterize central bankers, future or current or past, as whether they're doves or hawks. Many people are complaining that Janet Yellen is a dove because she's advocated easy policy a lot. Many people say, for example, Charlie Plosser at Philadelphia is a hawk because they say he wants to have tighter policy. I think that's a very misleading characterization. In fact, I think that people who want to be dovish, they maybe try to focus on reducing unemployment. They're called doves for that reason. Frequently, the unemployment rate gets higher because of dovish policy. Actually, I think you saw that in the 70s. They tried to keep unemployment down. It eventually got higher. So to me, the doves are actually hawks. In fact, the hogs are maybe doves. I don't even like that terminology for that reason. But another terminology is how rules-based are people? How desirable do they want to get to the Fed to be a limited-purpose institution which focuses on the basics and doesn't try to do all these other things, discretionary versus rules? I'd like to see more attention paid to that. It's some people picking up on it recently, but I think that would be useful. Anyway, that's the second positive thing. Some people at the Fed want to have a rule to exit the quantitative easing. I think that's promising, too. Jeremy Stein is the governor of the Fed. He's working on that. There's the article in the Wall Street Journal this morning about this, and I'm one of the skeptics, their quote. But it's a good sign, I think, that at least people are thinking about they got to get to another strategy. There's proposed legislation in Congress, quite a bit of legislation to try to move the Fed towards this rules-based policy. It's coming usually from the Republicans now, so it's really not going to go anywhere until more Democrats got on board. And then finally, I'll just leave with this as maybe you may think I'm too hopeful, but I want to end on an encouraging note. Many central banks have over the last 20 years adopted this notion that we should have a 2% inflation target. Not 6, not 5, but 2. 20 years ago, they didn't even have these kinds of concepts. And so it's seeping through the system. The most recent bank was the Bank of Japan, the European Central Bank, the Fed recently, the Bank of England. And so this is actually has the potential, it seems to me, to have a more rules-based system. At least you're agreeing on what your overall target is. It's actually an interesting thing. John Razian mentioned the so-called Taylor rule. That's 20 years old. But I chose in that to be 2% to be the inflation target. Nobody was doing that at the time. And so, in a sense, it's a movement towards a more systematic thing. It's just a teeny step, and it could be many steps backward. But overall, it seems to me, if you just to maybe conclude this, if you look at the history of the Fed, not just the last 100 years or the last 50 years, you can see these patterns of what works well and what doesn't well. It's in the data. And a lot of it has to do with how systematic or rules-based, how limited purpose the Fed is. It doesn't get into all these other actions, which generally lead to problems. And that's also correlated with this de facto independence, because you could imagine when you start to get involved too much with doing other things, losing your independence, you're going to start to get away from the rules. So they're quite related, and you can see those in the history. And then based on that, it seems to me it's clear where we should try to be going. We're going to be working on this at Hoover. We're going to have a conference in April. Our little contribution to the centennial of the Fed to try to make this case with a lot of our scholars and people associated with Hoover. So it's going to take a while. I just heard the finish of Victor's talk about how it's going to take a while till we get on track on foreign policy. I think it's going to take a while till we get back on track on monetary policy. But I think we will get on track if we keep making this case. Thank you very much.
This podcast has been a production of the Hoover Institution. Thank you for listening.